Hi, it's Jason from AQuest Wealth. And now that you have at least a little bit of a handle on how provisional income works, let's go through an example.
Let's do this.
So let's assume for a moment that you're married and have $36,000 of Social Security between yourself and your spouse. Now, if you can remember that provisional income calculation only counts half of your Social Security. So far so good. So you are $14,000 at that point below the threshold where half of your Social Security would be taxable. I know this is confusing. That's why we're kind of putting it up here as well so you can follow along. Now let's assume that you need $65,000 to live annually. So you're getting $36,000 from Social Security, so you need another $29,000 to live comfortably. It's probably also safe to assume that if you're watching this video, you have some investments, maybe a 401k, a Roth IRA, and a little nest egg in the bank. Now, if you're like most people, you feel comfortable keeping some savings for a rainy day and heard that you should spend your Roth IRA last because it grows tax-free. So far, so good. So you just take what you need from a 401k or your IRA. Uh-oh. That additional $29,000, as you can see here, of taxable income, because it came from a pre-tax 401k or IRA, was added to half of your Social Security. And that gave you a provisional income of $47,000. Ugh. Unfortunately, this is $3,000 over the threshold where now 85% of your Social Security is taxed. Right before you made that mistake of taking the money out, it was zero. That's a huge bummer. Now, most people, A, just simply don't know how this works.
Hey, you got a clue.
B, they don't care.
Don't care, couldn't care less.
Because they don't think they can do anything. Or C, they have no idea what to do about this problem.
What do you do when you don't know what to do?
This is where AQuest Wealth comes in, and this is what we're awesome at. A lot of you might not think it's a big deal. I mean, doesn't this just happen to everyone? Maybe.
Never happened.
What?
Never happened.
But if you are watching this video on creating tax-free income, it probably is you, and it should be as the person who cares. Why give 1 cent of your hard-earned money to the government if you don't need to?
Damn straight. Damn straight.
Let's think about this a little bit more critically, because this couple that we just talked about actually got clobbered more than you even thought from our previous example. I'll highlight that you can do to solve this problem, and we'll discuss how taxes actually work. So again, your Social Security at its core is completely tax-free. This couple screwed up, and I'll make up this word, the tax-freeness of the Social Security entitlement by withdrawing more taxable income than the law allows.
We screwed up. Message received.
Now, if Social Security is at its core tax-free, you could take some money out of your IRA and stay below that provisional income threshold. That means that only the money above that threshold created the tax for this couple. Does that make sense? I know it's a little bit, getting in the weeds here. But you could have taken out $14,000 taxable dollars from your IRA, and none of your Social Security would be taxed. That means that the last $15,000 of IRA money that couple took caused 100% of the taxes that this couple paid out a year in retirement. Well, how much was that tax, and what's the tax rate? That's actually a really good question. So first, let's take a look at the tax brackets of this married couple. As you can see, the first $19,750 is only taxed at 10%, so not too bad. If their taxable income is $19,751, they have jumped into the next tax bracket, which is 12%. Now, just to make sure that we're speaking the same language, I'm going to ask you a very important question that almost everyone gets wrong. If your taxable income is $19,751, we know that's in the 12% tax bracket, but how much of your income is taxed at 12%? All of it? $1 or none of it? Now, if you're just watching this video, you can answer incorrectly, and that's okay because you don't have to feel embarrassed, but the answer is actually only $1. If you thought it was all of it, don't worry. That's what everyone says. Now that we all understand how the progressive tax brackets work, let's get back to our example.
Let's get on with it.
So this couple had $65,000 of total gross income, minus about $24,000 in standard deduction. If you remember a couple years ago, people had standard or itemized. Well, now, due to some changes under the Trump administration, it's now almost everyone uses the standard. So that gave them $41,000 of what's considered taxable income. This is what's taxable, what the IRS is going to hit. As we have just learned, the first $19,750,000 gets taxed only at 10%. And then from $19,751 to $80,250, that gets taxed at 12%, which is $2,760. So you take $1,975, which is the tax on the first $19,750, plus $2,760, which was the tax on the second tranche or the second group, because remember, only everything above $19,751 gets taxed at 12%. So you take the $1,975, which is the tax on the first $19,750, plus the $2,760, which is the tax on $19,751 up to their total gross income of $80,250, and that gives you a tax of $4,735. So this couple basically created an almost $400 tax every single month out of a $5,500 total monthly income that didn't need to be there. It's a huge percentage of their income.
That doesn't sound good.
No.
So, maybe they can afford it, but think about it. Most people have what I would consider like their base, right, or core of recurring expenses. Things like property tax, heat.
67 copies of Moby Dick.
The movie or the book?
You made a book out of that?
Food, car insurance, things like that. Those expenses eat up a lot of your budget. The rest of the money above and beyond your core expenses is, am I enjoying my retirement money?
You know what I think? I think you're enjoying this.
Well, maybe I am.
I knew it.
So if you consider that a lot of that $5,500 monthly is probably eaten up by typical monthly expenses, let's just assume for a moment that their am I having fun in retirement monthly amount might only be about $1,000. Well, if 400 of that is eaten up by unnecessary taxes, it has, a pretty big impact on, a pretty small impact on your ability to live, but a potentially huge impact on your ability to retire your golden years or to enjoy your golden years.
Are you going to stand for that?
You're darn right I'm not going to stand for it.
The biggest problem is that this didn't even have to happen.
Yeah, well, let's hope not.
So in our next video, what I'm going to discuss is Social Security killers and how a bunch of strategies on how to avoid this tax so you can enjoy your retirement to the fullest. If you got a second, please hit that like button, and I'll see you in the next video.